Hello and welcome you to another edition of Industry Overviews. Today we will be talking about cement, and this is a very important sector for the overall development of a country, and because it is an input towards infrastructure, towards real estate. So we'll take a look very quickly at the cement industry. We will understand what the industry dynamics are, and we will also take a look at what is going on in the industry. So, first things first, uh, disclaimer: any stock that we discuss today, it is only for illustration purposes and for us to understand the sector better. They are not recommendations to buy or sell. Please consult your financial advisor if you want to, if you're investing. So, what is cement? I think cement is something which all of us know about. It's an inorganic material which is mixed with water, and it forms a sort of a slurry, a paste. And then, if you leave it out in open air, it hardens over time, right? Uh, its applications are very wide, mainly in the infrastructure, buildings, roads, construction, etc. So there are lots of types of cement, but primarily what we have, the main type of cement is Portland cement, and variations of Portland cement are used for different when different features are required. So, for example, if you need very uh, when you need cement in a very uh, chemical rich environment, so you want probably super sulfated cement. In oil wells, you have oil well cement. uh, Moisture resistant cement, you have hydrophobic cement. So different types, just the additional chemical composition is slightly different, but primarily cement is of the Portland variety. Interestingly, in India, if you see the production of cement, roughly 70% is Portland Pozzolana cement, which is called as PPC, and 20 to 25% is OPC. So between 85 to 90% is roughly the Pozzolana cement. The Portland cements. The other terminology that you probably will hear from time to time when you are studying this sector is the term called clinker. Now, limestone, when it is mixed with clay and sand and heated at very high temperatures, it produces an intermediary product which is known as clinker. And then this clinker is taken and it is mixed with gypsum and fly ash to uh, produce the end product, which is cement. Now, what is the process flow for manufacturing cement? It is the first step is the main raw material is limestone. So limestone is extracted from the limestone quarries or mines. It is the limestone rocks are then crushed and made into a powder. Sand and clay is added, and a mixture of sand, clay, and limestone is heated. Once it is heated, it forms clinker. After cooling it down, gypsum is added, and then it is again ground, made into a powder, and that is when actual cement, the final cement is produced, and that cement is then packed and shipped out to customers across the country. Now, one very interesting feature of cement is that cement is a commodity which cannot be transported very long distances. The main reason for that is not because it is very heavy and dense and things like that, which is obviously true, but so is steel. But steel is transported very long distances. So the challenge with cement is that cement actually absorbs moisture from the air, right? And it becomes hard. So unless it is handled with extreme care, and which is practically not possible, because if you want to really make it waterproof, completely moisture proof packing, then the packing itself becomes extremely expensive, so which is not really feasible for a commodity like cement. So what typically tends to happen is that cement needs to be consumed very close to where it is produced. And for this reason, you will see that uh, across India, across all the zones in India, you will find cement plants, right? So south of India, you will find east, west, north, central. Every corner of the country or every region of the country, there are cement plants, and more or less they are well distributed. Now, let us look at what are the main components and cost structure of a cement plant. First thing that we need to understand is that making cement is very, very energy heavy, which means that 30 to 35% of the total cost of cement production is uh, goes into power, and this power is generated using coal, so thermal power. Now, a lot of cement plants have a captive source of power. So they have very close power plants, or they have tie up with power plants, or they have their own power generation units. And a few companies like Ambuja, Ultratech, they also have their own coal mines. Right. The other interesting aspect here is that, like we discussed, that cement needs to be consumed very close to where it is produced. The two main ingredients, cost wise and availability wise, for producing cement is limestone and coal, and these are available in, so limestone is available, say, largely in Rajasthan, in Andhra, in Madhya Pradesh. So you have cement plants close to either those states, or it is close to uh, the coal belt of India, which is West Bengal, Jharkhand, Bihar, Odisha. Now, with regards to mines, limestone mines, till 2015, mines were given out on a first come, first served basis. In 2015, what happened was the Mines and Minerals Development Act got amended, and mines were started getting auctioned. And if you win the auction, you would get a lease of 50 years. So uh, any company which won an auction was reasonably assured of the input of limestone for the next 50 years. Now, the challenge with this amendment also is that it also has a clause which says that mines that were allocated to a company in the past will have to be bought back into an auction from 2030 onwards. So in 2030, you will have limestone mines which were auctioned off before which were given off before 2015, coming back into the auction fray, and then the companies which have the existing mines will have to bid for it. Now, here the challenge will be that, let's say you own, I mean, you have the rights to a mine today, and you have built your cement plant next to a mine. If you are unable to get that in auction once more, then uh, your cost structure for that existing plant is going to go for a toss. So you are going to get forced to buy those mines when 2030 comes. So this might be a inflationary challenge for those companies which have rights to mining that were taken before 2015. The next important point is, because of the nature of the commodity, freight and logistics cost. So basically transportation and storage. And typically, cement has a shelf life of between 60 to 90 days roughly, right? And again, the reason I explained, because it sort of absorbs moisture from the air. Now, because of this challenge, some companies, what they are now doing is, to reduce freight and logistics cost, is they are breaking up the production process into two parts. The first part is uh, up production up to the clinker stage, so the grinding, heating up to clinker, and then you have another plant which is closer to the consumer, where you take the clinker and convert it into the cement. So this is how companies are trying to uh, reduce to an extent some of the freight and logistics cost. Now let's come to the pricing of cement. So again, a lot of other uh, commodities related to housing or related to uh, infrastructure. Here, the actual decision making of which brand or which type of cement to be used lies not with the end customer, or not with the person who is actually paying for the service, but lies with the contractor or the mason, right? It is very similar to Fevicol, or using pipes, for example. So plumbing pipes, you don't go and ask your plumber that I want XYZ company pipes to be put in my toilet, right? It is always that you tell the plumber that I want this to be fixed, or I want this to be laid, and the whatever the uh, specialist decides, he then goes and sort of buys that. So same thing here. It The ultimate decision making of which brand, how much quantity, etc., of cement is to be bought lies with the contractors and masons. Now, the cement companies have essentially two ways of selling, or two types by which they sell. One is trade sales. So this happens through the normal traditional dealer, distributor, retailer network, where the end product, the cement, is sold to retail customers like you and me, or they are sold to small builders, contractors, etc. Here the pricing or the margins are much higher, but the volumes sold is lower. The second is the non-trade sales. Here, very large organizations who are, say, essentially into infrastructure development, or governments, they will go directly and buy from the company directly. Here, the size of the transactions are very large. They're bulk deals, but the uh, pricing here is, because it is negotiated, and you have to give discounts because of the volume, the pricing is significantly lower. Now here we've got two examples where, say, a company like Shree Cement is moving more towards trade sales, so uh, uh, higher margins, higher value, lower volumes. Whereas Adani Cement is going the exactly other route. They are more focusing on the trade segment, where they are going to have more volumes, but lesser pricing. So there is no right or wrong in this. It is the strategy that you follow, and what is your business model. What you will see is that roughly there is some difference in the trade and non-trade. The gap, if you see, has roughly always been about 80 to 100 rupees between trade and non-trade, which is not a small amount. I mean, if it's roughly one third of the uh, price. So between 25 to 30, 35, sometimes 40% difference is there between trade and non-trade because of the volumes. Now comes the major challenge that the industry has faced over the last many years, which is that the price per bag of cement has been stagnant for roughly around 14-15 years. It has just not grown. And it has been stuck around that 300 to 350, 370 mark for the entire period. If I look at the industry as such, right, we can broadly divide it into three time periods. The first phase was from early 90s to 2003. This is where industry got deregulated, capacity started building up, and overall the industry was starting to pick up. The next phase, which was 2003 to 2010-11, that has been the best phase for the cement industry till date. It peaked out with about an aggregate of 92-93% of capacity utilization, and where the industry's overall cement price CAGR was at its peak of 8.4%. This was followed by about now 1.5 decades of the worst industry phase ever, right? And the main reason for this slump is that between when the times were really good, between 2003 to 2010, every cement company put in capex, augmented their capacity, and they wanted to have larger and larger plants and wanted market share. So huge capacity came in. Once the demand sort of fell, these companies were there stuck with very large capacity. Pricing crashed, and then they were forced to do volume push. So they were trying to push as much volume as possible, which sort of killed their profitability. So over the next 1.5 nearly decades, the cement industry went into a slump. And also during this period, both infrastructure development and real estate actually did not pick up significantly. Now what we will do is we will take a look at a few comparisons. We have taken the top 5 companies in the industry, most of the prominent companies. The objective is not to compare these companies, but through these numbers over long periods of time to understand how the industry has moved. So here we are not trying to understand whether Ultratech is better than Shree Cement, or both of them are better than Dalmia Bharat, or whether ACC and Ambuja is better or worse than these other three. The objective here is to look at the overall trends that these numbers are telling us. And what we see is that Shree Cement over the last many years has been the lowest cost procurer of raw material, and even today it is at the lowest cost of raw material. But interestingly, what has happened is that if you look at say the last 15 years, and this is what we will do going forward in these comparisons, is what we will compare what was there in 15 years back and what is the current trend. So if you see, other than Dalmia Bharat, every other company, their cost of raw material has actually gone up over the last 15 years, whereas Dalmia Bharat, the cost has sort of shrunk a little bit. Now what it means is that if you see 10-15 years back, the cost of Shree Cement at that point in time was literally less than half or nearly 1/3 of the others, right? They have maintained their cost leadership, and others have also tried to sort of contain, with the exclusion of Ambuja and ACC that you can see here. The total production cost, if you see again, other than Dalmia Bharat, everybody's cost of production has gone up. And if you see, both Shree Cement and Dalmia Bharat have lower total cost of production compared to the others. This is the overall total cost. Again, here Shree Cement continues to between Dalmia Bharat and Shree Cement, they continue to lead in the from the cost perspective. Realizations, Ultratech has the highest realizations, very strong retail brand. But the other interesting thing here to observe is that Shree Cement here has been very consistent in its growth in realizations. It has been roughly 15%, 17%, 18%. So it's been a very consistent player who's been able to raise its prices on a consistent basis. Now, EBITDA per ton, everybody has struggled. In terms of power and fuel cost, here we see something very interesting. Is Ambuja and ACC has been able to reduce its power and fuel cost over many years, especially lately, right, in the last 3 years, primarily because of the Adani acquisition. Because now these companies, in terms of Adani Cement, they are able to capitalize on the coal mines that Adani has, the private rail network, the port, etc. So that is what has helped them. Same you can see here in total freight cost as well. So the mode of share in transport, in cement transportation, if you see, it is bulk of it is still roadways. Railways is about 25% and waterways is 3 to 5%. Some part of this benefit of railways and waterways has come to the benefit of Adani Cement because of the parentage. So overall supply chain cost, obviously, this tells us the same story. EBITDA per ton, again, same story. Now, this is a very interesting part of what is unfolding slowly. Is what we saw is places like Rajasthan have limestone deposits, and it is also a place where solar power is sort of now becoming very, very a lot of supply of solar power. So a lot of these plants are now trying to move from coal, which is expensive, to renewable power. So this is a shift which is beginning to happen. And so there are two components for reducing the cost of power in cement. One is obviously moving towards renewable energy capacity. So you will find every company trying to do something related to renewables. The second component is better waste heat recovery systems. So again, that is something where most of these larger companies are putting in significant amount of effort and capital to bring in cost efficiencies. The next is value-added products. So in the industry, what we have seen is that prices have been stagnant for 14, 15 years now. So the companies are trying to get better margins, get higher returns. And one way that they are trying to do it is through value-added products. So one of the most important value-added products that this industry now is ready-mix concrete, or RMC. So typically, this means that the concrete production is done very close to where it is used, right? And this is a higher margin segment. The absolute leader in this space is Ultratech, and it is also one of the reasons why saw the realizations of Ultratech to be higher than the others. So Ultratech right now has around 397 RMC plants. ACC roughly has about 90. Shree Cement, through its new acquisition, has plans of scaling their RMC plants from 5 to about 100 in the next 3 years. So again, all the large players moving into something which is more value added. The other value added item that people are doing, this is not as much as RMC, but is white topping. So This is made out of Portland cement, and the Pradhan Mantri Gram Sadak Yojana is using this for increasing the shelf life of roads by about 15 to 20 years. So these are the measures that are being taken. Now, one of the most important developments in the industry has happened because there has been a lot of mergers and acquisitions in the last few years. So if you see in FY17, the market share of top 5 players in the industry was around 40%. Today it is 62%. So it has been a 50% rise in the top 5 players market share in the last 7-8 years. So that has been a very big game changer. So a lot of these smaller players have now got merged or acquired by larger players. So Adani being a major player who's done a lot of acquisitions. Ultratech has done a few. So now you have much larger players in this space. Eastern India as well as across the country, you can see capacity additions continue to happen. Now we come to the main focus area. So after a major slowdown in the last decade, cement demand is beginning to revive, and this time it is happening because both infrastructure and housing have started picking up together. That is not happening. It has not happened for a sustained period. Last 1-2 years, we've just started seeing it happen. And as this trend develops, it is going to actually give a fillip to the cement industry, or at least that is the hope. Now, look at the investor presentations, say of Ultratech or Dalmia Bharat or all of these, any players, they are talking about roughly 6 to 8% growth in the overall cement demand. Now, here is basically a outlook of what the cement demand is going to look like and where the things will change. So from a capacity utilization of roughly 65-66%, the expectation is that it will move towards 75 to 80% in the next 6 to 7 years. Along with that, the overall demand, which has been stuck in the range of 3 to 4% for the last many years, is going to go to 7 to 8%, or maybe even higher in the next 3 to 4 years. And that is going to be led by both infrastructure as well as housing. So the main monitorable for us in the cement industry is we have to keep a check on is the capacity utilization on an aggregate and in the companies that we are looking at going up, and is the price of cement per bag going up, right? That is the next thing that we are seeing, is that the price of cement has started inching up. This is the 4th quarter in a row where the prices have moved up. It's not that it has not happened before. Now the only question that we have to see is whether this trend continues, whether this trend can sustain. And for that, this is a few snippets from the Screener con call notes for this quarter from some of the top players. And let's look at what they are saying. So Ultratech is saying that the strong government capex in roads and infrastructure. First quarter saw 2,108 kilometers of highways being built, which is roughly 9% growth YOY. Large projects like Vadhavan Port, dams, Maharashtra Shaktipeeth Expressway are supporting long-term cement demand. And they mention state-level development like Bihar, Andhra, Gujarat, Maharashtra are outperforming in capex and cement demand. When I look at Shree Cement, very similar kind of a commentary. They're saying this quarter saw a robust rebound in cement demand attributed primarily to increased government capex, broad-based economic activity, and a pickup in the residential sector. Right. So they are also talking about rural demand improvement on the back of good monsoons. Right. So that's something interesting. The company expects cement demand to grow at 6.5 to 7.5%, driven by infrastructure, rural recovery, real estate momentum. Right. So again, basically, sort of suggesting that our assumptions of 7% plus growth is what we are looking at. Adani Cement, again, very similar kind of commentary. They are saying that industry supply, so basically, which means that the capex that or the capacity growth that is there in the industry is to grow at 6% CAGR and demand at 7.5% CAGR through to 2030. Capacity utilization is expected to improve, supporting price stability and profitability. Right? Very, very interesting comment from one of the largest players. So this is Gujarat Ambuja and ACC combined. In terms of pricing environment, they are saying that pan-India prices have improved by 7 to 10 rupees a bag, which we already saw in the previous slide. And they're saying that further momentum is expected in FY26. So the expectation is that the price per bag is going to increase further this year. South and West are seeing strong recovery, whereas East and North are subdued, because I think East and North had done before in the last 2-3 quarters. So management sees positive price trajectory, which is very important. Price trajectory here is basically cement price trajectory, underpinned by government capex, housing, and rural demand. So basically, if you see, all the managements are now talking about in the same language. They are saying that government capex, housing, and rural demand is giving a fillip to overall demand and strengthening the price. So I think that is where the industry is poised right now, at a very interesting juncture. Results that have come forth in Q1, quite a few of the companies have come out with decent results. What we need to really focus on for this upcycle, if it happens, is number one, is the price of cement per bag going up? Can it cross the 400 rupees per bag and stay there, sustain itself there? And is the capacity utilization at an aggregate level going up? These are the two main key monitorables in the cement sector, and that is what we will be looking out for. Thank you. Thanks for watching, and do feel free to put in your comments in the comment section below.